All right, this is unit 2. This is going to be liquidity. Like I did in the last video, I'm not going to do too much talking. We're going to get right into it. So most traders think that price moves randomly, but that's not true. Price moves from liquidity to liquidity. Institutions need liquidity to enter and exit positions. They can't just do it instantly. They need to get liquidity to make moves. And liquidity is basically where orders are sitting in the market. This is why price is attracted to certain highs and certain lows. Now let's get into what is liquidity. Liquidity is basically where a lot of stop losses are and where a lot of pending orders are. So institutions need price to get to these stop losses to get more capital to make moves. And retail traders place these stop losses in obvious places so institutions know where they need to go to get these orders and where to get liquidity from. And price often moves to these areas before the actual move happens. Price needs liquidity to make a move. So if price wants to go up, it will go down first, take the stop losses, grab liquidity, and then make the actual move up. Now there's two different sides of liquidity. There's the buy side liquidity and the sell side of liquidity. The buy side of liquidity is highs and the sell side is lows. So basically above highs, there are stop losses, and below lows, there are also stop losses. So that's where price is going to go to grab liquidity. Now, when there are equal highs in the market, so this is what an equal high would look like. Price goes up, goes down, goes back up, but does not make a higher or lower high. The highs are equal. This is where a lot of liquidity sits. And the same thing can be said for the exact opposite. Can I flip this? I don't even know. No, I don't think so. But basically the same thing can be said for this because equal lows are being made. And that's where a lot of liquidity is sitting, on equal highs and equal lows. Liquidity is sitting on all types of highs and lows. There can be older highs and lows that are still holding liquidity. Now we're going to get into why price takes highs and lows. So we're going to put why price takes highs and lows. Now beginner traders or inexperienced traders see breakouts and think that's where they need to take their positions. But that's not how it works. Liquidity needs to be taken before a move is made. A real breakout usually has some type of displacement or continuation. Now I'm going to explain what a liquidity sweep is and what it looks like. So price makes a high here and makes a low. And now price is going to go up, grab liquidity, and then make a move down. That's basically what a liquidity sweep is. So up here, there is a lot of liquidity. Now, when price comes and breaks that, so it would be taking a lot of stop losses, it has a lot of capital. These institutions have a lot of capital to make a move to the other side. So that whole move, that whole thing of price going up is just to grab liquidity for a move to the downside. Now, another thing that is a form of a liquidity sweep or taking liquidity is a rejection candle or a rejection wick. So let's say this is a candle. We have a wick, or actually I'll use this. We have a wick like that and a wick like that. I'm actually going to change this one to look like that. Oops, sorry. So as you can see, this wick is a lot larger than the other one because that is a rejection wick. Basically, price wanted to move, price started here or whatever, and wanted to move down, and it did. But before it could close there, it already grabbed liquidity and made a move back up. Liquidity is where a lot of retail traders get stuck and they get trapped. Usually it's inexperienced or beginner traders because they don't really understand how it works yet. But once you understand how liquidity works and what it is, you can take a lot better trades. Now we're going to talk about what liquidity looks like in trends. So what liquidity looks like in trends. So let's say we have an uptrend, right? So price is making higher highs and higher lows. In an uptrend, a lot of people have their stop losses on the lows. So either this low or even this low. Now, the institutions know that because that's an obvious place to put your stop loss. So what will happen is price will make this high, but break this low just to grab liquidity to make another move to the upside. And the same thing can happen on a downtrend. So I'm going to delete this and do the same thing for a downtrend. So we have a downtrend, price is making lower lows and lower highs. And then all of a sudden, price is going to break this low and then make a bigger move to the downside. Or sorry, break this high and make a bigger move to the downside. That move is just price taking liquidity and knowing where these stops are and using them to create more capital and to gain more momentum towards a bigger move. And liquidity isn't just when it's breaking these obvious highs and lows. Liquidity is gained through every move in the market. So if price is making this low here and it makes this high, it is taking liquidity by making this high. It is taking liquidity to make another move down. And it's doing it again. It's going up, taking liquidity, making a move down. Going up, taking liquidity, making a move down. So if you want to use liquidity, we'll get into how to use liquidity. If you want to use liquidity to your advantage, you can't chase the breakouts. You have to wait to see a reaction after liquidity is taken. And once you see that reaction, you can make a more educated prediction of where market is going to go after. You want to be watching for liquidity sweeps, rejections, displacement, breaks of structure, because liquidity can help you in so many ways. It can help you with stop placements, it can help you with entries, it can help you with take profits. So for example, if you take a trade like this, you would want your stop loss to be below this low, because you know liquidity is going to be taken, could be taken from this low. And if we're on a trend, you want to have your stop below that low. And if you're entering off the concept that I'm going to teach, you'd want to enter about when price is here, and then your take profit would want to be up here, because that's again another point where liquidity can be taken. Remember, it's the highs and the lows. Same thing again for the entries. We're entering on a previous high, which is a point where liquidity is being taken from. Now I'm going to get into some of the beginner mistakes. So the beginner mistakes. Some of the biggest mistakes that beginners make in trading come from not understanding what liquidity is and how it works. So beginners would enter right on liquidity. They'd enter right where stop losses are. So that's where price is going to go down to or go up to and flip in the other direction just to gain liquidity. Another mistake is placing their stops at obvious levels. If you have your stop loss at an obvious level, we already know that institutions move towards these obvious levels where they know that stops are, so they can take liquidity. So why would you put your stop in a position and at a level where these institutions are already heading towards because of other people? Another misconception that a lot of beginners have is thinking that every breakout is a continuation of the trend or a continuation of whatever position they're in. Most breakouts are not immediate continuations of a trend or of a setup or whatever. They're usually a move to take liquidity before actually making the real move. And one of the biggest mistakes that beginners make is not paying attention to the liquidity being held on the higher time frame. So you need to be looking on the higher time frame for obvious points of liquidity, because if you're on the lower time frame, it might not look as important or as obvious as it is. But once you go and you look at it on the higher time frame, you get a better understanding about what these levels actually mean and how attractive they are to institutions. So you can't be ignoring the higher time frame liquidity. You need to be paying attention to it. And another mistake that a lot of beginners make is trading in the middle of nowhere, where there's no liquidity, there's no structure. You need to be trading where the liquidity is, and you need to be using it to your advantage. If you're trading in the middle of nowhere where no liquidity is sitting, price isn't going to have structure and it's not going to move in your favor. It's probably going to flip the other direction to grab liquidity and make a move, and you're not even a part of it. You're just getting caught in that move unnecessarily, when what you could be doing is using it to your advantage and taking a higher probability trade. Liquidity is one of the most important concepts that any trader in the world needs to understand. It does not matter what strategy you trade, liquidity is necessary for every trader. Market structure relies on liquidity, and direction relies on market structure. So if you're trading without understanding what liquidity is, you're trading without market structure and you're trading without direction. Liquidity basically explains where price wants to go. So why wouldn't you want to understand it so you can use it to your advantage? And once you understand what liquidity is and how it works, a lot of the charts and a lot of the markets that maybe used to scare or confuse you look a lot cleaner and make a lot more sense. So if you want to know how you can get a better understanding of how it works, you can go onto a live chart right now and just look for points of liquidity. Look where price went to and flipped in the other direction. Or try to look for places where obvious stop losses would be placed. If you do that, eventually you'll get a better understanding of what liquidity is, where it is, and how it works. That's it for this video. Thank you for watching. Next video is going to be on Unit 3. Stay tuned.